Glad you were able to join us this afternoon. We're going to be talking about mastering the loan sizer for smarter deal structuring. Do me a favor, if you have any questions, please feel free to throw those in the chat box, and we'll do our best to get to as many as we can today. Let me go ahead, though, and introduce our facilitator, Alan Johnson. Alan's our Director of Originations. Not only is he on our leadership team and our wholesale team, but he's also a top producing loan officer here at RCN. And we do have a lot to cover. So, Alan, feel free to take it away.
Thank you, Tiffany, and good afternoon, everyone. Thanks for joining. So we thought that it would be a good idea with everything that's changing in the real estate market these days to take some time to take a look at the sizer that we generally send out to you guys on a regular basis to help you understand how to use it, right? So generally we'll use this as a pricing tool, also as a tool to be able to determine whether or not this is a loan that's viable for RCN capital, as the majority of our guidelines are actually built into our sizer. But I'm going to talk a little bit about those aspects of it, but I want to focus a little bit more on the sales side of this piece because rates are beginning to drop, and we're starting to see some rates in the 5s, and I think that's very impressive and a huge selling point for our clients that maybe they don't know about because everything that they see online is going to be in the low 6s right now. So so we're going to get started because it's kind of a quick training. We're going to start off with our loan purpose. For today, we're going to use cash out. Obviously, refinance RT is rate term, delayed purchase. We'll use that if the loan is within our seasoning period, and then purchase is self-explanatory. You want to be able to choose the correct citizenship: U.S. citizen, permanent resident alien, and foreign national. Permanent resident alien will function the same as a U.S. citizen as far as our guidelines go, so you won't see any reductions in leverage there as you would on the foreign national. The FICO score will be going here, and we're going to get back to this, but I want to make sure that everybody understands how critical this number is. We see a lot that come over with specific numbers that maybe somebody's getting off their credit card statement or something. We got to make sure that this is right, especially when we're first quoting out our loans. And then our property details here. I use just a generic property here. Everything in this section is extremely important, except for the street address. So I do see sizers coming over from some of the clients where it's missing the city, and the only thing they're really putting in is the zip code and these two numbers here. It's very important that we have the city, state, and zip code in here, as well as these two. The street address obviously does not have an effect on anything in the sizer. And then our property figures, these are pretty self-explanatory numbers. Our loan terms, we're going to look at how we can maximize this loan using some of this information here. And then our occupancy and rental income section here, along with annual taxes, insurance. Our flood would go in here as well if it's in a flood zone, and always look for any annual HOA that goes into the calculation. Even though we do not escrow for it, it has to go into the calculation for cash flow and DSCR. Another section here is the square footage for the property. I get a lot of questions daily. What's our minimum square footage on, say, a single family or a condo or a 2 to 4 unit, whatever the case may be? Once you fill out this section here, it tells the system what the minimum square footage is. So your answer would be right here. Our minimum square footage on a single family house is 675. The new sizers, obviously this is very new, the ones we have today, which was another reason why we wanted to go over this. Treasury was able to go out and get the data per zip code on home price appreciation for each zip code, median home value for each zip code. So this is the median home value in this particular zip code here. And this is important to note. not necessarily on the DSCR loans, but on your rehab loans and your ground up construction loans. Another section they put here is market rents. So this is going to be based on the zip code. It's just, it may not be 100% accurate, but it's giving you what the common market rents are going to be for that zip code. So this is very helpful for you if someone's telling you that they're renting it for $3,500 a month and we got $2,400. There's a good chance it's not going to come in at $3,500. The other piece that I want to talk and spend most of my time with is your pricing options. So generally speaking, when we send these out, you're looking at the max proceeds and what we can do here as far as the maximum loan amount, interest rate, and then the DSCR that's associated with these particular pricings. What we want to spend a little bit more time doing is looking at this section here. And what I mean by that is every one of your clients is a little bit different. And getting to know your investor and what's important to them is going to really dictate what kind of loan you're going to want to sell to the client. Most clients are looking for either max cash out, the lowest rate they can get, or cash flow, right? They need their properties cash flow or it doesn't make any sense. So when we look at these and we have these conversations with our clients, we want to understand, obviously they want all three of those things, but what's the one thing that's most important to them so that we can really find the best solution for that client? So in this particular scenario, maybe rate's a little bit more important to them than cash out. So going 300,000, all right, well, the rate's pretty nice at 0 points to RCN at 7.025, but maybe they were looking for something more in the mid sixes. Now you can come up here and you can go, okay, well, we can buy the rate down 1.75 points and get them to 6.5, right? Or you can come over here and go, okay, wait a minute, we can do 240,000, 0 points to RCN at 6.6, and then you guys can charge your points over that. Well, I like the 240, but the 6.6 is still a little too high. Well, what if we were to do 240,000 and maybe 1.5 points to RCN and buy down at 6.25, and then you can charge your points on top of that, right? So you'd have to kind of do the math in your head when you're talking to your client. But this is important. So what you're doing here is you are giving your client the options of 300,000 at 7.025, 240,000 at 6.65, or 240,000 at 6.25. So you have three options for three different types of loans. They're most likely going to choose one. Now, at the end of the day, you're making a loan on either one of those three. If we go at this client and we go, okay, I can do 300,000 at 7.025. All right, let me think about it. The 7.025 might be the only thing that they're thinking of that's holding them back, and they're thinking that might be their only option. So you're giving them an option to answer with yes or no. Yes or no is never a great option to give a client, right? So as you're looking through this bottom section here, make sure you're understanding what the client's looking for. So at 300,000, this has a DSCR of 1.02. It is not cash flowing at all. So this client's going to have a property that is not going to cash flow and quite honestly might be costing them money if anything happens on that property. It will be a negative cash flow at that point. So you want to make sure you understand these things here. You may have something where we thought the rent was going to be 20, the lease was 2,500, but the market rent came back at 2,000. See how your loan size has changed, right? Our DSCR dropped below 1. Now our max loan amount is 240,000. But this client, the cash out is way more important to them than anything else because they need that cash out to go buy an investment property to continue growing their portfolio. Down here is where you're going to start looking at your different options to do that. I don't know that many of you know, but we have another prepayment penalty that's has a little bit lower rate than this one. So this prepayment penalty is 5% for 5 years. This will increase your loan amount and decrease your rate slightly. Not a huge difference here. But you have interest only options as well. So you could do a 5-year interest only. Now you're back up to 263,000 here, or you can do a 10-year IO, and now you're 267,000. So if this client plans to hold on to this property for 5 or 6 years and they're going to sell it, maybe the IO option is what's most important. It could be something that could get you where you need to be to get that loan closed. When I was talking about the interest rate earlier, we get a lot of scenarios that come over and most of them have a 700 plus FICO. Think about the FICO buckets. Once they go, they're in 20-point increments. So when you look at this, this is 720. You'll notice it's a 720 bucket. Now you're at a 740 bucket. The rates went down. 760 rates go down. So this is really important for you to make sure that we get this right. If your client says they have a 700 FICO and you're quoting out a 700 FICO and the FICO comes back at 699, it's going to completely change your loan. Meaning 699 is going to bring you down to the 680 bucket, increase your rate, and decrease your leverage. So when you're working on these types of loans and someone says that their FICO is 700, I would most of the time I would run that at 699, or I would explain to the client if it comes back less than 700, it's going to change everything significantly. You want to make sure that your clients understand what's going on, what could happen if things don't come back the way they're telling you. And as you all know, your clients are pie in the sky sometimes, right? So they think their homes are worth a little bit more than they are. They got that credit score from their credit card report, and it's one score. It may be their highest score, and the rest are all lower. And we see that quite often on our side when we pull these tri-merge credit reports. But I think the biggest takeaway here is to make sure you truly understand what your client's looking for. Look at what's going on. Is the property going to cash flow? Is this going to be the best loan for your client from an investment standpoint? Is the project going to be the way they want it, right? If they're saying, hey, listen, I'm going to retire on my portfolio of rentals, this one they're not retiring on. They're basically they're not making any money on this particular property. If you take a look at some of the other information that is provided by the sizer as well, I'm just going to change the zip code real quick. And if you'll notice down here, the home price appreciation is a negative number. So it's going to be a depreciating market for the next 6, 12, and 18 months. So again, we're going to be at 75% loan to value, but this property is actually going to depreciate by about 5% over the next 18 months. Now, this is data that we pull from several different websites, and it's fairly accurate. And speaking with Rick Sharga and stuff like that, these people that are really close to this data, they're saying all the same things, right? That some of these markets are going to depreciate, and it's going to be a lot of the markets that were growing so significantly over the last few years. So Florida's grown significantly over the last few years, and now we're starting to see pockets in Florida that are depreciating at a significant level, and we got to keep an eye on that. But this should change your conversation with your client. You know, this market is going to be depreciating 5% over the next 18 months per the data that's out there. Maxing out your leverage may not be the smartest move, because if you want to do something later on down the road, you may not be able to, or if you want to sell it, your return's probably not going to be where you think it is. So that's our DSCR sizer. I hope this helps a little bit, but please make sure that you're looking at everything here. You're getting to know your client. You're understanding what is most important to them, and you're presenting several products to give them options to meet that need. And always ask them, what don't they like? What do they like when you do give these options, so that you understand where their mind is. It'll truly enhance that sales ability with that particular client. And if you give them the right one and they're happy when they walk away, it's going to be a repeat client for you. And we all know the repeat business is the best and easiest business we can get. So we're going to move over to the RTL sizer. This is probably the sizer that changed the most with the new iteration that was sent out. You're always going to start up in the upper left-hand corner. And this sizer is now incorporated ground-up construction. So you can choose ground-up construction, RTL, which is going to be your bridge loan with rehab, and then a bridge, which is going to be your straight bridge. Our guidelines are different for both of those. That's why we separated them out. So right now we're going to do our RTL. So they're going to do a purchase. Again, their FICO score is 700. They have 3 in experience. Experience is the number of completed rehabs in the state of the subject property in the last 3 years. So they have 3. Once you put that 3 in, you'll notice over here in the upper right-hand corner, it's going to give you your max possible leverages for that particular FICO score and experience, which 90% is pretty legitimate. I think that's pretty solid for 3 experience. I know most of you have been with us for a long time, know that that's not always been the case. You're going to complete your property details the same way you did on the other one, and then you'll get down to your property figures. So they're going to purchase a property for 200, put 75,000 into the property, and their after repair value is going to be $400,000. It's going to ask you some questions here. Is it going to be a tear down of 50% or more? If the answer is yes, then we're going to have to run this as ground up construction. Change in property type or units. So are we adding or reducing the amount of units that are currently in the property today? If you choose yes to this, it makes it a heavier rehab. In most cases, they won't be, but it's important to know. And are they expanding the property by more than 20% or 750? So 750, anything under 750, it doesn't matter what the percent of the property square footage is. We still don't count it as a heavy rehab. So in this particular case, we have a light rehab where 37.5% of the purchase price or as is value. Our return on investment is 42.35%, and our projected ROI is 119,000. Once again, on this one, we're getting our 6, 12, and 18-month home price appreciation or depreciation. Median home value, just 436,000, and our ARV falls within that number, so we're good. And then it's going to give you market rents of 2412. This is important to note here, because if for whatever reason we get the appraisal back and the return on investment does not meet our minimum of 10%, we can always fall back on this 2412 to see if the debt yield works. If the debt yield works, then it passes and we can move forward with the numbers that we have. We have a 42% ROI here, so we're good to move forward. What I want to, again, talk to is this number here, the FICO score. Again, it just comes in at 699. This is going to change us to 85% of purchase, 100% of rehab. It reduces your leverage. So be careful when someone tells you that their FICO score is 700, that will make a difference. If for whatever reason, this number comes back, the ARV comes back at 325. So you still have a passing return on investment of 15.66%, but you'll notice there's out-of-pocket rehab that needs to be done now. We are maxed at 75% of the ARV, which is why our number now is 243,750. 11,250 will need to be paid out of pocket by the client before we will start allowing draws through our servicing. There's a couple of different ways you can do this. You can do it just like this, so you can price it just like this, where they're going to pay out of pocket before we'll start doing draws. Ultimately, what we would prefer to happen is that we take the 243,750 minus the full rehab budget of 75,000 and get our initial advance. That would be the way we'd want to do it, so that we were covering and financing 100% of that rehab budget. It helps us as a lender be able to track the progression of the rehab because we're doing draws, we're doing inspections. It helps us just in case if we see some hiccups happening, we can get involved early and maybe help. But if the client prefers to do the 90% at closing and then do the $11,000 in out-of-pocket rehab, that is an option for them to do as well. The other thing I wanted to talk about here was the differences on the zip codes as well here. So you'll notice home price appreciation here, and this was the same zip code we use on a DSCR. We have depreciating market, right? So that's when you're in a 12-month loan, it's a little bit more significant than if you're in a 30-year loan. So we get a 10% reduction for home price appreciation. This is going to be pretty standard across the board when you see significant numbers. I think the numbers get 2.5%. So anything more than 2.5%, home price depreciation is going to get a 10% leverage cut. And you'll see down here on the right hand, it kind of gives you an idea of where you're going to see these types of situations. Now you're going to see it in other areas other than here, but these areas here are extremely important to note. I had a sizer this morning that came over in Lakeland, Florida. That is something where we need to kind of revisit the entire sizer and understand that the minimum ARV for something in Lakeland, Northport, Cape Coral, and those other areas listed below need a minimum ARV of 175,000, where in any other area, you're going to be at a minimum ARV of 115,000. But you will, once those are identified, they will actually come up here. And you'll see an additional 10% reduction. Being able to utilize this sizer before you're talking to a client about pricing and leverages in a particular area, having this up and being able to throw that zip code in there and fill out this sizer will help you understand where we're going to be, right? We can tell people all day that, you know, with 3 experience, we're going to be able to do 90, 100, 75. But if it falls into one of these areas or has a home price appreciation with a more than negative 2.5%, we're not going to get there. So being able to do this beforehand is going to help you with your credibility with your clients. One of the things that GridZone Network is actually going to be coming out with in I believe 2 days, when you put an application in the system, you're going to be able to download the sizer right from GridZone Network, and it's going to populate all the property information that you have in BLN into that particular sizer. So you'll be able to do it quickly without filling out the sizer. It'll do it for you and you'll be able to identify it quickly. There's going to be another, I'm going to do this really quick for you just so you see it, but let's say this comes back at $1 million. You're going to note there's going to be a 10% reduction because we are more than 2 times the median home value of this zip code. Now, generally speaking, in the past, we've had to get exceptions on this, but if we have 3 public comparable sales by property type and sales price over the last 6 months in the immediate area, we can remove that 10% reduction. So in order to determine this, probably the best route at the beginning is to go into Zillow and do a search of sold properties within that area. You can put in the filter that's going to match up to the bedroom, bathroom, square footage size of that property. You can put in sales in the last 6 months, and you want to look to see if you have any sales coming up. In certain areas of the country, they're non-disclosure, so it's going to be a little bit more difficult to determine, like Texas is a non-disclosure state. It won't have that information in Zillow, but for the most part, you'll be able to go in and do that. Now, if you know that there is sales there and it's going to be within the 6 months, we're going to probably need to wait until we get the appraisal back to determine that, to show that the appraisal does have those comps within the last 6 months, but there is a way to remove that. Now, this only applies to single family homes. Should not apply to a 2 to 4 unit. So if you have a 2 to 4 unit, that's not an issue you have to worry about. We do understand that those are worth, or those property values are a little bit more significant than single family. All right, we got 1 minute left. I'm going to run into the ground up construction real quick. So if you just change it to ground up construction, we have all our information here. I'm just going to change this really quick that they bought this property for $50,000. They're going to put in $400,000 to build a property, and it's going to be worth, call it $650. We want to make sure that we have permits and plans by the time they start doing draws, hopefully by the time they close. But you'll notice the same thing here where we have an out-of-pocket for rehab costs. In the past, we used to have them pay that at closing, and they would be prepaid rehab costs, but now they're going to actually work the same as the rehab loan, where they're going to have to pay that $17,500 before we can start doing draws. So they will do $17,500 worth of rehab based on their rehab budget before we'll start doing draws. The other thing that's pretty cool is that we can do it with zero experience. So with zero experience on a ground up construction, we can still make this loan and it still looks really good. We're going to need probably a contract from the builder, but we do not need to do the we won't need to do the contractor review anymore through CFSI like we had in the past. We've made it a lot easier for these clients to get approved for these types of loans. As we've noted many times in the past, a lot of these rehabbers are not able to find those deals anymore, so they're reverting more back to ground up construction, but they're not able to get that lending because they don't have experience. So our treasury team's gone out, did a nice job getting us approved to be able to offer ground up construction with no experience. I know that was really quick, and I appreciate your time today. What I do want you to do, though, is if you feel like this is something that would be helpful for you and your teams, I am happy to do one-on-one calls with your team, whether it be through Teams or go to webinar like this with your team, specifically answer questions, let them walk me through different scenarios so that I can help them understand the sizer and how to best present to their clients. Just reach out to your loan officer, let them know that you'd like this to happen, and we'll get something on the calendar as soon as possible to make sure that they can start presenting loans and understanding our guidelines and products fully to be able to present to your clients. And that's it for me. Do we have anything else, guys?
No, great job, Alan. That was super informative. If anybody has any questions, feel free to email our correspondent lending team at RCN or your individual loan officers. Thank you guys all again for joining. I will be sending the recording of this training out as well to everybody. So I hope you guys all have a great day.